Hello, welcome to Introduction to Business. Today is going to be our last chapter, maybe one more chapter. I think I could be able to put in, personal finances. Today we're going to be talking about managing businesses' finances. This chapter here, we're just going to be talking generally about business, how it pertains to you, businesses when you need additional capital, and that's cash. Do you utilize debt financing? That means you take an IOU, either bonds or take a loan out from a financial institution, or do you do equity financing? Basically, sell stocks into your company. And now, what if you do have additional revenue? Do you invest back into the business, or do you find another stream of income to put that money aside in case you need it for the business? So you may invest in another, buying stocks or shares, or buying U.S. Treasury bonds as a way of compounding your income or the revenue that you have, or your profit or retained earnings, or money from your accounts receivable, for lack of better words, to make more money with money. Remember, the whole thing in business is to make money on the money that I have in my possession. Good economics. In business, I try to get clients and customers to pay me as soon as possible. I give them some incentives, maybe 2% off if you pay me within 10, 15 days, because I figure if I needed to get my own cash flow, I needed additional cash in there. If I had to take out a loan, it would cost me 4%. So by giving them 2% and getting the money to me sooner, I able to utilize that money more effectively and efficiently. Okay, so remember, for here we're just going to be talking about business finances, and we will talk about first. You're either taking me an online class or face-to-face class, or your instructor provided this link to you, or you somehow found me on YouTube. If you found me on YouTube, please sign up. Find me in a community college. I'm teaching at. Just so I pay off for my student loans. If you can't find me, sign up for other instructors at community colleges. Most of us are practitioners. We have our degrees in their discipline, just like a full-time instructor would be. We're contractors or adjunct instructors. The only thing that we bring into the mix is we are practitioners. We actually implement and could give you real-life examples of how this is important from a real-life usage, not only academic, but we give you experience in how from a business, whether you're open up a business or you're a department head and you're moving in within the corporate ladder, or your business is growing and now you have to find different way of funding your business, or how do I improve my cash flows and other things that we'll talk about. All right, so this is just a summarization. You could take me for finance or take another instructor in finance. You'll take already a couple accounting classes. This is just to kind of let you know, hey, I'm in business. I have to understand the money area. We've talked about accounting before. We talked about pricing. Now we're going to talk about how do I get additional capital to expand my business, or to buy my inventory, or just because I have additional money for some reason, and right now it doesn't make sense for me to uh, put it back into the business. I will invest it in another aspect, and that's when we're from accounting, different streams of income coming in. So let's talk about money. The first thing you have to understand about money, you talk about net present value, or time value of money. What is the money worth today as it is, or what will it be worth in the future? We're going to talk about compound growth. We're going to talk real briefly about stocks. We're going to talk about common stock and preferred stocks, just so you know the difference. We're going to talk about dividends. That's the profits. How to give back to the shareholders, or if they are shareholders. Investing to fulfill financial objectives. Reasons why we should be investing. Exchange trade funds, what that is. Business of trading securities. And securities are stocks and bonds, or IOUs. Two classes of stocks. Individual investor trading. Risk. The higher return on my investment, most likely there is a higher risk factor involved, and that's why I'm getting more higher interest rate back, because maybe the investment, or it's a new business, or it's a new market that they're trying to fund, and my money's being funded, so they'll say we'll give you back, instead of what a bank will give you 3%, 4%, we'll give you back 15%. No different than if I take a loan and I am a new business or a brand new individual. I have to deal with students, and they go, "Man, do you want 21% interest, Dr. George, on my for a charge card? You have no credit at all. Pay to take it. If they're willing to give it to you for 21, don't abuse it. You only get it for about $500 if you're lucky, or $1,000. Pay back and forth, and this shows the character. I give you something in advance. My word is truthful. I could pay back. Same with a business. Okay? So, and then after you establish your credit, if you pay back right away, you don't have to pay the interest. Here's how much I charge. I come back and I pay them back the same amount, and I'm using that amount, the charge card, showing that I am responsible, credit worthy. I have a good character. My word means something. Then, after you've established that, you go for another credit card at a lower interest rate, because now you're established. And then you can start bringing your do you see how you're doing? That's finance. How you bring it from high. Get some credit. You have no choice. No one knows you. And then you start working your way down to get the best credit, because now you understand the market. Same thing, we can learn, how do I invest? Why do I invest? Should I bring in new shareholders or owners or stockholders, or should I just try to get create a bond, an IOU, or go to the traditional bank? What are the ramifications? What are the pluses? How much could I write off? That's where accounting, and my accounting comes into the play. But if I'm looking at managing business, this is all finance. Remember, accounting gives me, as I explained in an earlier chapter, is like a bathroom scale. I sat on it, it tells me how much I weigh. Pure detail. This is what my revenues are. These are what the journals are saying. These are what your ratios are saying. Just like the scale. This is my body weight. This is everything else. That's it. Now, finance is the dietitian, the individual, the manager, the person who's looking at it and saying, I've got all this knowledge. I see where all these parts are coming from. How do I improve the return on my investment? How do I bring more cash in? I know I have to do more marketing, but I don't have the money to buy a better campaign. So how do I get that loan? How do I get more investors to believe in me? They like the idea, but they're always looking at, hey, how much do I give back? What do I get? I'll help you out. No, you're going to grow, then you buy more of my product, or right now I'm selling or I'm renting my product or leasing to you, or I'm buying it to you. I'm trying to help you out. I'm giving you some of my expertise, because in the long run, we become a business connection. We become a business network. We come a logistic, a resource for each other. You pay me, I pay you, things work. But now, do I buy? Do I want it now, or do I want your services later? So when finance is the network, or time value of money. What is the value of the money now, and what could I buy it later? So if I save it now, and I get an interest rate for compound for 3-4%, I go, wow. Then later on I have more money. That only depends if the inflation rate doesn't go up, or the cost of living for the goods. Because if I get it at 4% in compound, let's say I get about like 8% at the end, I got some money there. But now the inflation rate is at 12%. It ate up this up. It didn't make sense. I was better off to purchase now, build now, with the money maybe a little bit higher, because the inflation will degrade the value of my interest or what I have put away. It's worth so much. But, you want it to grow. So, and that's what we look at investments. When do I expand my business? When do I contract my business? When do I sell my stocks? When do I purchase my stocks? I'm looking for an individual. And remember, I'm going to try to do personal finance, one more video after this. Usually in the book, we got the 17 chapters. Those of you taking me for a course, the personal finance will be like extra credit. But that's something you should know. If you understand your personal finance, it's real easy to understand your business finance. This was the first time I was using this, the author, this way, and I was going through the chapters. Now I understand. I'll try to show the personal finance before we go into the accounting and everything else. Now you start thinking, here's how I understand with the money and business finances just a little bit more. Okay, I got to keep on going or I'll be over my hour. Usually in this one I'm going to be a little bit more than an hour, maybe an hour and 20 minutes. Okay, so what's the value of money? Remember, we're just summarizing. We talked about this. Let me make this a little bit larger so you could see it. I'll make it a 200. So those of you, okay, you have access to my concept maps at the second tier. Added in principle that invested money grows. It's like a seed over time by earning interest or some form of return. That's my return on my money. Whether I put in a bank and the money grows, or I buy a share in that company grows, and then I sell it, and so I'm getting a return on investment for that dollar. Remember we talked before that dollars are the value of that currency. So, but what do I put that currency towards? Okay, now compound growth. If you look at compound growth, those of you got any kind of charge cards or anything else, when I put something else in, I don't even touch it. Compound of interest over time. With each additional period, the interest returns are accumulated. And here's the rule of 72. We talked about this. You could find the number of years needed to double your money by dividing the annual interest rate by 72. The rule can also try it, and then here you can see where it's going. See, 1 year your compound interest 27%. How much will go, how much the initial investment grows over a year. Okay, it compounds up. All right, I'll leave it at this because I don't want to go too much because I'm going to run out of time. Look at it, read it in the book, just divide the numbers, and you'll find out how much interest how much interest, how much your money's going to grow over the time period, or you can find out if you have an interest payment or anything else. Put that in there. How many years to pay off your debt. You'll be surprised. Okay, now let's look at the stock. You got the stock exchange. Now, before I go into stock, I had two classes of stock. Let me just move this over. I thought I'd change this. Remember, we are live in my recording. Two classes of stock, and then I'll go into the author. For some reason, this book did not go too much into. I might have missed it. Okay, so you got two classes of stock. You have common stock. That means I have ownership. All right. So most basic form. Holders have the right to vote for the board of directors. And when we look at the board of directors, remember, I never elect management. I elect the board of directors. And then from the board of directors, they elect the management. This keeps me as a stockholder similar to a silent partner, that I don't do anything with the management, so I can't be sued. So this way I have a limited liability, because only what I lose is, even though I'm an owner, but I'm not a full owner, I'm like a silent partner, okay? So most basic forms have the right to vote for the board of directors, shares in the profits of dividends if they are approved. Now, if the company doesn't make any dividends, I don't have nothing. That's the profits after taxes. I don't get anything. If they do, how much? Usually about 30% to 75% of the dividends go back to the shareholders. That's why I'm invested in the organization. But sometimes the management or the board of directors could decide and say, hey, we need to hold these dividends back and hold them and put them into our retained earnings. Retained earnings are money, and we'll talk a little bit about that I know I got to expand the business. I know I got to fix the floor. I know I got to do some maintenance work in the future. And, so I have to have this money put aside to maintain that, so I could have the shutdown and do the repairs or the maintenance, whatever I need. So I will take that out of the profits for next year, and I tell them, hey, no profits, it's going to retain earnings. Okay, so but they understand that. That's just part of it. And then remember, you could also, they could sell the secondary market. We'll talk about how they could sell the shares in the secondary market and make money, just like a house. You buy so much when you buy it new, and then down the road you buy it, you sell it, and you make money, because over time it appreciates. Not like a car that depreciates. Now, preferred stock is same thing like a common stock, but you give away something. In business, when I give you something, I take something back. I'm a business owner. I'm not a charitable organization. Even not a profit. They give you something. They give you some food. Sometimes they want you to believe in their cause or the religion. Remember, or let's leave it at that. So in business, if I give you something, I'm going to take something away. So preferred stock is, I don't care if the stock grows, I am there just for the dividends. I want to put my investment, like I put money in there, and I live off the interest or the return on the investment. So I want to be guaranteed that I get I get the dividends no matter what. Now, owners are given preference in payments if the company dividends before common stockholder dividends are distributed. So I get it first, and then you give it to the common stock. The other thing, there's three things they talked about: is callable, convertible, and cumulative. When I have a preferred stock, that means I no longer could vote. I give the voting rights, but I get the dividend. And if the company didn't make any profit, so there's no dividends to paid out by the face value of the stocks, we'll talk later, I will be able to get those dividends in arrears. So basically, when they do get the dividends, they have to pay me back the last several quarters or whenever the dividends were supposed to be paid out, because they owe it to me. Okay. Now the callable version is I could call that preferred stock and make it a common stock. You as an owner could convert that preferred stock back into common stock. Once you convert back, there's no way going back. Once you convert, you are converted. And cumulative, and we talked about that the dividends have to be paid back no matter what. That's the only time you would have the face value of that, what the shares worth, because the dividends are off of that face value, not the secondary market, off the initial public offering. We'll get a little bit more. I'm just giving it to more. When you take me for finance, we get a little more detail on that. Okay, so now let's go. So now you know the two types of stock. So I buy the stocks. I issue the stocks to the company. I can buy the stocks, make money of it. They're an owner in it, or instead of like a silent partner, this is something that's transferable back and forth. Or I could basically issue stocks if I am. Remember we talked about different types of organization, not an LLC, limited liability corporation. I could bring partners in, but I can't issue any stocks. But you could do as a Chapter S, a small corporation. You have to have all the paperwork. And if you're not sure, look it up on YouTube or take a course back into Business Law 1 at the community college, and they'll go a little more detail. So now, but I got the shares, and we talked about that. Now, how do I trade those shares? How do I exchange them for money when I need them? Okay, so you could exchange them to a stock exchange. It's an organization of individuals to provide an institutional auction setting in which stocks can be bought and sold for an initial public offering. This is what I want for them. You buy them, and then after you purchase them, you want to a secondary market. They'll either go up or down. Okay, select a global market exchange, and here's a chart. And so you got Australia. Remember, when you look at the stock exchange, the U.S. got the New York Stock Exchange, the Nasdaq. That's the electronic one, over-the-counter stock exchange. Or you could just sell stocks to individuals, no exchange. You could come to your business and say, "Hey, I want to buy the stock," and you exchange it. You're selling them ownership, like a silent partner, giving them a certificate. But different countries, different regions have their own. They got Australian Stock Exchange, Tokyo, Toronto Stock Exchange, China, Shanghai Stock Exchange, Hong Kong, even though they're part of it, still a separate kind of a unique situation and financial structure. All right, Japan Stock Exchange. And if you look at it, even though they're both Chinese, theoretically, in theory, and by the rule of law, I'll leave it at that. But just look at the New York Stock Exchange and the Nasdaq. So just still even they're both the U.S., but different format, a different kind of people buying different securities for different reasons. Okay, and in the United States, it says New York Stock Exchange and Euronext. That's the one that when you want to buy from the U.S. and you want to buy European, you'll go into this stock exchange. From New York Stock Exchange would be your portal, for lack of better words. Okay, and then the Nasdaq is for National Association of Securities Dealers Automatic Quotation System. Yeah, I always go Nasdaq. Some people as soon as say, "Hey, Dr. George," was, "Oh my goodness, let me look in the chart." Who remembers? Nasdaq basically is on an online computer, and you see the board and a lot of things. Nasdaq is all you can buy computerized. The world's oldest electronic stock market, consisting of dealers who buy and sell securities over the network, and that's the Nasdaq. All right, and non-exchange trading is electronic communication network, and this is not ECN. And if I look at that, I look at e-trading or some of the other ones. I'm just trying to do something that would make it easy for you to see, or you could use it to some of your exchanges. Electronic trading system that brings buyers and sellers together outside traditional stock exchanges. Another way that remember, the government always wants you to buy, invest. If you invest in companies and I grow, remember the government, I grow as an organization, I get more people, I buy more products to make my product, more people buy my product, there's money exchange, I hire more people, economy grows, they tax me, they tax the worker, they tax everybody. What do I have? But I'm growing. So the government wants me to grow. So it's opened up different revenues for me to get funding, other revenues for me to sell something, for people to buy into my organization, small or large. All right, planting seeds. Okay, so common stock investment. Okay, we talked about the stocks, portion of ownership, and I probably could have put that in here. All right, I'll just leave it this way. Okay, and then common stock, most basic form, and then here I put preferred stock. This is just a repeat. I just added that in from my own, from another course I'm teaching. Okay, stock values. Now, the market value is the current price of the share in the stock market. Here's what I ordered, here's the market value. The book value is the value of a common stock expressed as the firm's owner's equity divided by the number of common shares. The book value is used as a comparison indicator because the market value of successful companies is usually greater than the book value. If I look at Apple, if I look at the book value, it's less than what the market value is because people are looking at the name, the recognition, the following, the tradition. People just, when I get Apple, it's the innovator. It's the one I want. I'm just making it up. I'm not making it up. That's what they're selling on. All intangible. So it's worth more, that intangible, the name of Apple, than if I try to just sell all the pieces. Here's the store, here's the equipment. Do you see what I mean? So if you look at the book value versus the market value, people want to pay more for it. God bless them. Okay, when market prices falls to near book value, what is the book value? Some profit-seeking investors buy the stock on the principle that it's underpriced and will increase in the future. Remember, when you're buying something, a same house could be built for the same amount of cost, $120,000. But I put it in an area that may not be the most desirable area. It's next to a train station, next to an airport. I'm just trying to throw that in. So there I could only sell it. It may go out maybe 2-3% a year. But I take that same structure, same design, and I put it in an area next to a wooded area, next to a nice golf course, next to a lake. That thing could increase double over the 5-10 years. Not because of the structure, because of everything that's in, good school districts, no airports, no nothing, no pollution, because of the area. Same thing with when you're looking at the book value of a company. Okay, now look, a lot of people are still buying into Wells Fargo, even though it dropped down on that. The stock dropped down. Why? Because they're going to come up eventually. People forget about it, and they'll say, "Hey, if somebody get caught like that, odds are there's the ones that want to put the money back in because everyone's watching them. So they already got the rules of the restriction." Yeah, in most cases, I'll try to take never mind. I'll keep my own personal opinions in here. I'm teaching you basics this here. Okay, what are dividends? Dividends are payments to shareholders. Remember, that's after I paid all my on a per share basis out of company's earnings. Dividend payments are optional and variable. The corporate board of directors decides whether and when dividends will be paid, as well as the amount that is best for the future company and shareholders. Many companies distribute between 30 and 70% of their profits. Remember, for me to get dividends, I have to make profits in an organization. Profit means I paid all the taxes, and I go, Sam, Mr. Sam, anybody in the same family. I'm just kidding. And municipal, all these, everything else. And now, what's left is what I pay out dividends after I decide how much and how much. I still got to run the business and looking for expansion. That's what the shareholders want. Okay, when we talk about blue chip stocks, are common stocks issued by well-established and respected company with sound financial history. And if you look at a lot of the Dow Jones and some of the indexes, you're looking at the blue chip, the number one. If they're growing, people have investments in buying into them, odds are the economy is going good. If they're not having investment in the larger, solid ones, odds are they're not investing and having faith in the smaller businesses. I want you to understand the rationale. That's what we discussed in the chapters in the book. Remember, you're not going to get everything out of here if you didn't read the book, you didn't do the interactive homework assignment, you didn't come to the classroom or discuss it in my online forums or discussion. An example is Coca-Cola, have historically provided investors steady income through consistent dividend payout. Okay, investing to fulfill financial objective. Mutual fund. That's the most easiest one to get in there. A company that pulls cash investments from individuals and organizations to purchase portfolios of stocks, bonds, and other securities. So you're buying a little bit of everything. Some are going to go up, some are going to go down. So you have the safety. You're not going to make you're better off if you're very specific, but you better understand it. But if you put all your eggs in one basket and you break them, oh gee. So you got different types of eggs and different types of investments or securities. We discussed that in class. Okay, and the same thing in the reading. Companies such as T. Rowe Price and Vanguard, that pull cash investments from the individuals and organization and purchase bundles of stocks and bonds and other securities, and then they sell them back off and say, we'll give you such amount of investment, a return, as long as I get my cut. And the problem is with a lot of the mutual funds, there's new regulations, depending, I don't know what's going to happen in the new administration, but the new regulations that allow that don't state that the fund managers have to disclose how much they're taking off the top to manage it. And if you find out, wait a minute, they're taking 20%, and I want to get a 1%, 2%, I want a bit more of the action. You're better off doing it yourself. But starting off, you see how the fund managers, which ones they're saying they're good and bad. Because remember, they're trying to get a basket. Some riskier one, some more stable, more secure one. Stable, secure one, you don't get that high return on there. The more riskier ones you did. But is he or she, the fund manager, doing a good job on that? Investors are, as part owners, expect to receive financial gains as funds assets become increasingly valuable. No load funds, and if you look at this, if you invest $1,000 in a mutual fund with assets worth $100,000, you owe 1% of that fund. Investors in no-load funds are not charged sales commissions when they buy into or buy out of the funds. All of this, do I pay it or not? Investors in load funds generally pay commission 2% to 8%. Okay? Hey, come on, I'm making some money off of this. Business. Don't look at me. I want you to understand what you're investing in and what you could invest out or what you're buying into when you're investing with your extra cash or your business or your personal. We'll talk about a little bit more in our personal finance. Reason for investing. Stability and safety. Fund stressing safety seeks only modest growth with little fluctuation in principal value, regardless of economic. All of a sudden, I'm looking for safety. I want the safe fund. Some of the utilities are fairly safe. Include money market funds are good ones that have preserved the fund's holders' capital, reliable current income. Remember, a lot of the people who made a lot of money to some of the Ponzi schemes is because I'm making a lot of money. Eventually, you're going to have it's not going to always go up. That's what happened with the housing. The price is going to go up. It's going to hit a peak, going to drop down, and it's going to start back up again. So as an investor, you got to look, okay, when is the peak or the bubble? Boop! Back down there, and let's start off again. So, and I'm up here. Here's when I got rid of it. When I got the most money, boop. Here's when I buy it. Because I now got the extra money, I can buy a bunch of them and work out. That's investment. That's what you have to do as for finance. Okay, so mutual funds stressed at preservations. Capital of current income also seeks some capital appreciation. You want it to go up a little bit, are called balance funds. Aggressive growth funds seek maximum long-term capital. They sacrifice current safety and income. Remember, you could go in funds that are very high risky, but it's almost like gambling. And I don't want to put it in gambling because it's more calculated. You're seeing what the environment's doing. You're looking at the historical trend. But even gambling is statistical and historical. The probability a certain number comes up with. But what you're looking at, and when you go into high risk, you're looking at, here's money I have. If I lose it, I'm not going to be on the street. Remember, a lot of people put all their money, all their eggs in, and they lose it, they're completely broke. I lose this, okay, so I won't go on a vacation, I won't do this. That's how you invest. The money you lose, but if I make money, I'm making more money. And that you keep that stuff that you invest, it keeps some back for put in security and keep the rest for the risk. But don't put all of it on one thing. I'm going to make this one thing, you're going to lose it. The odds are going to be against you. Take statistics or some of the other courses, take your math classes, you'll find that out. That's what the casinos are doing. Odds are against you. They're going to be in favor. Odds are going to be in favor of the market. But over time, it's going to have its peaks and slopes. Okay? Okay, exchange traded funds. Or a lot of times you'll see them as ETFs. Okay? Now, what's an ETF? A bundle of stocks or bonds. Remember, bonds are the child of the stock market. They're IOUs. They're even better than a bond. Well, maybe not. If you want growth, then you want the stocks. But if you want continual return, bonds are here's how much you're going to get. Remember, if the company goes under, you got to pay the debtors first because as stockholders, I'm last because I'm an owner of the organization. Okay, bundle stocks or bonds that are indexes by certain priorities, by certain indexes that tracks overall movement of that market. It's a bull market or bear market, more buying or less buying. Unlike mutual fund, can be traded like stock. Remember, exchange traded funds, other than mutual funds, I can't. I buy the mutual fund, I'm stuck with the mutual fund manager. But when I'm looking at index funds, I could buy an index fund and then trade that thing off, sell my portion off. Well, I can't do that when I'm doing, what do you call it, mutual funds. Okay? Advantage of ETFs is can be traded throughout the day like stocks, have lower operating cost in mutual funds. I'm not paying a mutual manager. I'm looking by index. I'm looking by certain types of stocks. I'm looking more for technology. I'm looking more for nonprofit, whatever. Okay, offer ease of entry. Investors getting started without much money. Okay, business of trading, security. When we talk about the securities are both IOUs and stocks, right? Stockholders or equity or debt. Those are securities. Stocks or bonds. Bonds basically IOUs. I'm sorry, I'm all excited. Okay, remember, take a course in finance and make sure you take a couple classes in accounting. This will make more sense. Right now, this is just a generalization, an overview, so you understand from business where am I coming with the money? What are they talking about? Okay, securities, bonds, stocks, mutual funds representing secured assets. Okay, claims by investors against issuers. Okay. Okay, security markets, markets in which stocks and bonds are sold. Primary security markets, markets in which new stocks and bonds are bought and sold by firms and government. New securities only represent a small portion of traded securities. Initial public offering, I put the money out there and then now it's going back and forth. I only put the money out there when I need more money for my organization. If I put too much money out there, I get too many owners. If the organization is growing, that makes sense. If it's not growing, people are going, why does he need more money? He's mismanaging. I'm not making a return any profits because I got to give out too much. Remember, think of the relationship. When I'm investing in a company, I want a larger organization that has a large profit. And so there's more people, I get more investment. If I only got $100 and I got 1,000 people in there, what the heck? There's no worth it for the profit. Man. Okay, secondary markets, where the money's at. In market which existing is not new, stocks and bonds are sold to the public. We talked about this. Securities exchanges, their emblem on here. Government agency that regulates U.S. security markets. Investment banking, someone that underwrites it. Financial institution that specializes in issuing and reselling new securities. Right, P.J. Morgan, basically one of them that is out there. Let me go on this one. Okay, oh boy, we got a lot to go yet. Not too bad. Okay, individual trading. When I'm looking at individual trading, just to talk about it, when I look at a stockbroker, you could go to a stockbroker and he or she will help you, individual or organization that receive and executes and buy orders on behalf of outside customers in return for commission. So I have someone that does it for me. I can get my own haircut, I go to a haircut place. Okay, online investors are, let me just bring it over here a little bit higher. Online investors buy into and sell out of stocks of thousands of companies daily. Keeping track of who owns them at what time has become a momentum burden. Relief has come in a book entry. Remember, when I used to buy stocks, if I buy stocks, I had to go to one of these brokers and exchange the stocks, and I'd get a new certificate of stock that has the name of the company on there. I always would have that title. It's like having a currency going on. Now, what they basically do is book entry ownership. I no longer ever see the hard copy of the stock. I just get a unit report saying, process that investors share and book full entry. They put my name in there. Because stocks are being traded back and forth. It was a nightmare. But I still like the hard copy. I like the cash currency. But that's technology, okay? So rather than paper certificate, I get a certificate. Say, here's George, here's your account. You have so much, you own so much of the stocks. Which is better for me or not? Here's what happens when I have it electronic like this. The government knows what I purchased for it, what I sold it. They know the profit. If I want to say, no, I didn't make that much, they say, here's the purchase, here's the profit. When they buy it in a hard copy, I got a date. I may say, I think I had it for a while. I just hand it over to somebody else in here. I got it for this much. I never changed it. I never changed the title. Just a little more ambiguity into it. Remember, the government wants to make its money. Nothing wrong with that. That's where it makes its money, where we get the services that we live in, to free society that we're in now. Or whatever government you're at. You know, to take care of your medical, hopefully, services that will help you out as a resident of that country. Okay, tracking the market using stock indexes. Okay, so I got stock. Okay, stock. Okay, market indexes. Remember, market index, a statistical indicator designed to measure the performance of large group of stocks or track the price of stocks exchange. That's all it is. It's an index. Here's going down. Dow Jones is going up. Dow Jones is going down. What's the index? How many? Bull market. Period of raising prices of stocks lasting 12 months or longer, featuring investors' confidence for future gains and motivation to buy. That means a lot of things activity. Bull market, people have faith in the stock. Now, what's the difference between a bear market? Period of falling stock prices marked by negative investor sentiment with motivation to sell ahead of anticipated losses. If I think the market is going down, I'm trying to get out of it and make as much as I can before it hits the bottom. And people are getting rid of it here. Other people are buying and selling, still making money. Buy. And finally, when it hits the bottom, I'm stuck with it. Okay? So bull versus anticipated losses. Remember, bull prices going up, bear prices are going down. And if I'm looking at the market here and expanded here, remember we had this in class. Look at how the bull market, right, going up. Here's where the bear market starts going down. Here's the Nasdaq is following it along. Okay. In the index that we were talking about. Okay, now if I look at the Dow Jones, the oldest and most widely cited market index based on principles of 300 blue chip stocks. Remember, we talked about 25 before, we were talking about 30 blue chip. They come and go, depending if they're blue chip, if they're a value. Some were blue chips, now they're penny stocks. Okay, now the S&P, Standard & Poor's, 500 is the market index of equities based on performance of 500 large stocks representing, let's go in here, representing various sectors of overall economy, such as information technology, everything else. The Nasdaq, let me put this in here and put it to the dictionary, okay, is an index that includes all Nasdaq, both domestic and foreign, with high proportion technology companies and small cap stocks included index for total approximately 3,400 firms. The Russell 2000 Index, specialty index, uses 2,000 stocks to measure performance smallest. I'm so excited. Let me slow down a little. Okay, Dr. George. Okay, smallest U.S. companies, range of sectors such as financial, consumers, discretionary, and health and technology. Okay? All right, so we got all these down. What do we have on here? Risk and return. Remember, when I'm going to stocks, the principle that safer investors tend to offer lower returns, whereas riskier investors tend to offer higher return to reward. That's the basic. Remember, the higher return, the more risk. So if it keeps on going up, that's when you start looking what's going on. Okay, while short-term investments are generally considered less riskier, longer-term investments are subject to future uncertainties in economies and financial markets. As of mid-2013, the average return of one-year U.S. Treasury bill was 13% versus 1.2 on a 5 return. What this saying is, again, the cost of money, what's going on, depreciation, inflation, that over the term, it may be, people like the longer term. You're better off with shorter term investments, just because you could adjust quickly to the environment, the external forces outside. Just leave it at that. I just confuse people, but we discussed that within our courses. Okay, investment dividends and interest appreciation. Okay, Current interest, dividends, and yield. These are just basic definitions, so I'll read them slowly. Yearly dollar document amount of income divided by the investment current market value expressed as a percentage. These are some of the ratios that the author we talked about. Okay, price appreciation, increase the dollar value investment at 2 points in time, the amount in which the price of security increases. So I'm looking at what the value depending on my security. When we looked at the graph, it made it as clear. I was going to say as mud. It made it clearer. Okay, capital gain is what did I gain on my investment. It is profit realized from increased value in investment. My total return, when you look at total return, especially in finance, total return is everybody that took some piece had to pay somebody, had to put a tip. What I have left, that's my total return. The sum of investment, current dividend, interest, yield, and capital gain. That's my total return. Okay? Now, financing a business, you could do secure loan backed businesses, loan to finance an asset, backed by a borrower, pledging an asset as collateral. Oh, sorry, let me go on this one. Okay, I missed one. My apologies. Please, I'm live. Managing the risk with diversification and asset allocation. Don't put everything in one basket. Manage it differently. Have different kind of aspects. Don't have one kind of customers. Have different customers that your product makes sense to. A lot of people want all commercial customers. Have some residential customers. Residential customers are a little more of a pain in the butt because they want more for less, but they are still a steady flow coming in. When your commercial dries up, I have something to at least break even to pay my bills. Okay, so what am I doing in here? Okay, diversification. Purchases several different kinds of investments rather than just one. Asset allocation, relative amount of funds invested or allocated to each several invested alternatives. So you have a backup on here. Portfolio. Your portfolio should be diversified. We talked about diversification in business and employees. Diversification, different managers coming in here. Diversification. Now let's go in finance. Let's diversify our financial portfolio. Combined holdings of all financial investments of any company or individual. A lot of businesses use, like myself, use an LLC, limited liability, because I can bring in different aspects of the business in there and still keep it in the needs of business and still have some write-off and still grow as an organization, small or large. Okay, so let's go. Financing a business. Financing the business firm. I get excited about this. Come on. Not nervous, I get excited. A lot of times when you're doing a speech class, you get like this, be probably very nervous. I get enthusiastic about the subject matter. You have to understand finance. You have to understand where I'm going to get the money from because you want it to grow. When you grow, you pay off your debtors and you go forward. That's what I'm trying to do with my student loan. So make sure if you find this out, you either contribute by taking one of my classes. That's how I pay off my student loans, my debt to society, for giving this. The economy went up and down. What could I say? I enjoy teaching. I do enjoy consulting, but I also enjoy relaxing. All right. Remember, in business, you got to find that balance. So the more successful you use utilizing your capital, your investment, your financial wisdom, the more you are able to relax. Don't try to spend more. Just relax. Have that break, especially now coming up with the holidays. Okay, so you've got that loan. Finance an asset backed by a borrower pledging assets collateral. You're giving something up as part of the business, part of ownership. So collateral is asset pledge for fulfillment of repaying a loan. We'll get a little bit more when we go into finance. What do you put in for collateral? A lot of businesses put their house and home for collateral. I kind of will go against that. Even though I know you want to start the business, your heart's in there. You're going to be successful. You got the motivation to drive. What if something happens? The economy crashes. Your business, something happens, and no longer is a viable option, you lose everything. Try to do your business separate from your home. Put your home in your business. You could put your, when you go for your mortgage, you're saying, yeah, I own the business, but that's all. It's income. But don't put your house up for collateral to open up your business. Because if you lose your business, your creditors are going to take your house. Your wife, I'm just kidding, your wife, not in the U.S., but the wife usually leaves, or the husband leaves, whoever, they'll take everything from you. At least this way you lose your business, you still got a home, you got a house. It's got to work for somebody. Use your financial wisdom, please. Okay? But if you have to do it, you have to do it. I'm not trying to tell you what to do. Remember, as a consultant, as an instructor, I try to give you the options and try to minimize your risk. That's why you go into an LLC or as corporation or a corporation versus sole proprietor or partnership. Okay, loan principal amount received, interest owned depends on the annual percentage rate divided by 12. That's not how much you're paying each month. That is agreed. That's what you can write off on your taxes and accounting. You'll find that out. That is agreed on between the lender and the borrower. The interest amount is founded by multiplying the APR by the loan principal, 0.17%. Almost my interest over a year, and that's compound what you owe. Remember, as you start paying off and you look at your mortgage, remember all finances, your term and condition. If you just look at when are you looking at your amortization, you want it starting right off the back. Half goes for the loan and the other goes for the interest. You don't want, like some banks want, I think after 5 years they have to amortize. So don't worry. But if you're having a small business loan, some of them want all the interest first and then your principal later pay off. You want 50-50 or a good percentage that it gets paid off to the principal. So if you default or if you go on, you've already got so much payment already paid into it. Okay, unsecured loan that there's no collateral. All right, we got that. The next one is angel investors and venture capitalists. When I'm looking at angel investors and venture capitalists, your family, your mother, the banks, no one is, even no one will give you a loan. Where do you go? You go to angel investor, or you get a loan, but you only can get so much because you're new and they're going to give you a limited amount, but you need more capital. Capital is cash. Business terminology, I need cash. Okay, angel investor. Outside investors will provide new capital for firms in return for a share of equity in the ownership. When I say share of equity, remember, you're bringing in this venture capital. He or she or an organization becomes part of that blood. They become part of that business. Okay, venture capitalists. Now, they're the same one. They private funds from wealthy individuals seeking investment opportunities for growth companies. Again, they're part of your management. They have a say in your management. So when they come in there and they say, sometimes it's good, it helps us go. But if the person has a undesirable background, be careful. It may be using money funding out. You may end up in more of a legal ramification with either the government or something else. So when you're bringing these individuals in, why do they want to invest? Because they want you to succeed, so they make more money off of you because you come back for more money. Even if you fail, they write you off as a business loss. To them, they're still making money. But they want you to succeed because as your business grows and they have ownership in there, they could either fully buy you out or you could fully buy them out as the company goes, and then now you have an ally part of your network. Okay, so now we go sales of corporate bonds. Okay, corporate bonds, real quickly. A corporate bond is a form of IOU. It's like a credit card, only I'm issuing it. A pledge, an IOU, a formal pledge obligating the issuer of the company to pay interest periodically and repay principal at maturity. The federal government also issues bonds, finance projects to meet obligations, as do the state, federal, municipalities, higher education, building of schools, roads, sewage disposals. That's what they put. They put a bond issue, and then the taxpayers in that area have to pay back. Remember, Detroit had bonds out there also. Detroit went belly up, bankruptcy. They cut on that, so you still could lose, but odds are, in most cases, they're safer than stocks. Okay, a bond indenture is a legal document containing complete details of the bond issue. What are the rules and requirements? Finance, you need that. Maturity date. These are just things on top of a bond that you could find as future date when repayment of the bond is bond issue is old. So you have your maturity date. If you get a U.S. Treasury bond in 25 years, it'll be worth $50. Now you only pay 20. Okay, face par value is the amount of money that the bond buyer lender, in parentheses, those who listen to me, lent to issuer and the bond will receive at repayment. That's the face value. It says $100. That's what if I after 10 years or 5 years, I will get $100. If I cash it in earlier, I'll get whatever it's the market value. It's worth it. So maybe if I cash it in 5 years, I only get $50 instead of $100. But I may only pay $25. But that means that that $25, I can't touch that thing till 5, 10, 20 years later with interest rate and compounds, what we talked about earlier. Okay, default on a bond. Failure of a borrower to make payment when due to a lender. tells me what are the ramifications. Request for court enforcement of bond terms. Bondholders claims, you got a claim, say, just like the credit company and mortgage, hey, you haven't paid, we're going to put in a foreclosure, what do we get in here? Mortgage-backed securities. Mortgages pulled together to form a debt obligation or a bond that entitles the holder investors to cash flows from bundled mortgages. Now, be careful. This is what happened when the mortgages crashed, because they kept on putting all these bonds in here. The banks were just getting out mortgages because they didn't have to maintain them. They went in here, and then went to another one, and they bought, and people after a while forgot who the heck owned it. Be careful. Now they have more rules and requirements, but still look at the terms and conditions. Okay, and in bankruptcy, when all fails, how the heck do I get out here? Court grant permission for a company not to pay some or all debt bills. When you go into bankruptcies, there's different bankruptcies. Take finance, we'll go into that in this case, just over. So when you go bankruptcy, they take some relief from your things. That's why you want to separate your business from your personal asset. When the business goes bankruptcy, they don't go after your personal assets unless you use that personal asset as collateral for the business. Then it's fair game. Okay, bond rating systems. When I look at bond rating systems, Moody gives a high grade, Standard & Poor's all A's, AABs, medium, speculative, poor grades when you go down to C. So look at it. Remember, it means higher. If they're at this poor grade here, I could get more interest on it, but I'm taking a bigger risk. Usually they go with the governments on that because they'll have that. Okay, now capitalization is the market capitalization, the market cap. In parentheses, total dollar value of the company's outstanding shares, market capitalization, debt financing, long-term borrowing from sources outside, IOUs, could be banks or even bonds, equity financing, using owners' funds from inside the company as a source for long-term financing, could be issuing stock or retained earnings, okay? And, we got one more. We're almost done. I think I went a little bit over. Okay, regulating securities. The government's involved. Prospectus, basically registration statement filed with the Securities and Exchange (SEC), containing information for prospective investors about securities. Where are we going in here? About securities to be offered and issuing company. So it basically gives you facts or background about the organization. Here's what the companies are. Here's the sound is. We already went into this. And information about that when you're going to securities. Okay, so it has to be formed so it's a legit company, and because people are going to be investing in this thing. Inside trading, and you got Martha Stewart, other individuals. Illegal practice of using special knowledge about a firm for profit. So I know the company is going to go bankrupt. I sell my stocks right away, and I make the profit, and then it goes on. So the government's looking why did he as an owner got rid of the stocks before the market actually knew it. It's illegal for an employee of a firm to tell others about anticipated event that may affect the firm's stock, such as acquisitions or mergers, or before the news are public. Or that the company's going to merge and it's really low and I buy it and all of a sudden the stock goes up, I'm making a lot of money, then I sell it. Okay? So what do we have here? Let's go in here real quickly. I want to go back. We've covered a lot. I understand that. This is the last. There's going to be one more chapter class. I am going to do the personal chapter. I will try to what do you call it? For extra credit, and I will. I'm just making everything here. Okay, so I will record chapter. I think it's personal finance. This appendix with this new book that we're teaching now, and I like the personal finance because you have to understand personal finance. Once you understand personal finance, you take the same skill sets when you go into business or open up your business. Again, my name is Dr. George Mochocki, and look me up. I'm teaching a finance class. I have some recordings. If you can't take me at the community college, take other instructors at community college. You're paying for your taxes. Community college is the best value for your money. Most instructors at community colleges are contractors, and we bring in the academic skills. We have to have the same qualifications as full-time instructors, but we also bring in experience, and many of us are either trying to pay off our student loans or trying to make a living out of this. So again, my name is Dr. George Mochocki. We'll see you in our next. Sign up for the courses at the community college, the best value for your money. If you're a small business owner, they have other section of community college. I've tried to always throw that in there. The small business administrations are usually located at community colleges. They have sections of community colleges that are very specific for small businesses' needs and wants, or corporates for specific training that your corporation or your business needs, and they could tailor to you. It's very inexpensive, and have people that have academic skills. That means they have what's going on in the community and you have real life experience, and they're also business owners and able to help you for your business to grow, and also let you know if there's any kind of funding from the government that could assist in this endeavor. Again, my name is Dr. George Mochocki, and I'll see you next time. Okay, bye.